Hey everybody, we are back again on Monday here with another edition of That's Our Two Satoshis Live. I'm Jeff Dorman, the Chief Investment Officer at ARCA, joined once again by now frequent guest Nick Hotes. How you doing, pal?
Doing good, Jeff.
Great. Well, before we get started here, a couple of rules of the road. This commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. But for those listening in, pretty simple here. Every week we write a blog on our website, ar.ca/blog, where we talk about things going on in the digital asset space. Try to be pretty timely with what's going on related to the market. Every once in a while, we drop a piece that's a little timeless, and that's what we did this week. Before we get to Nick's piece, which is about Blockspace and kind of how to define the Blockspace investing cycle, we'll talk a little bit about kind of what's going on in the current market. So, Nick, another reason to have you on this week is, once again, it's back to macro. I think I've been on record multiple times saying that we've decoupled. And I think that's true. I think all the evidence and all the data shows that outside of Bitcoin, which is obviously just an extension of macro, most other digital assets have decoupled for the last couple of months. We've had a lot of idiosyncratic events, restructurings, reorgs, bankruptcies, liquidations, events, catalysts, conferences that are kind of driving price action. But last week, there wasn't a whole heck of a lot of anything going on other than the Bank of England stepping in to buy gilts to thwart a default at some pensions in the UK. And obviously, a lot of movement there on the back end of that with regard to bonds. For reference, the U.S. 10-year note went from 3.60 to 4% and back to 3.60. We had some pretty big movement in corporate credits, especially in European banks. What did you see on the macro front that mattered to you with regard to digital assets?
Yeah, certainly the Bank of England point was, I think, the most interesting. Obviously, there was a lot of speculation this past weekend about Credit Suisse. I think a lot of crypto Twitter people fancying themselves Lehman Bros experts, but yeah, I think really Lynn Alden puts this really well. Is the situation right now is not really one where I think the financial sector is in a ton of risk from like a systemic perspective, where you really have risk is in the sovereign sector. So if you think that the global financial crisis is going to happen part two, I think most policymakers would say we're not going to let that happen. What you're really seeing right now is what we or what's really important too is what we saw in the UK with the gilts, and understanding what the issues are at a sovereign level, and how that's driving the kind of currency and fixed income markets.
Yeah, I think that's right. And, I think also, no disrespect to you, but I think you were, 10 years old when Lehman went under? Is that right?
Something like that.
I was trading
14.
CDS. Yeah, I was trading CDS at Merrill Lynch back when Lehman went under. And I can tell you, for those who aren't bond experts, obviously don't listen to people on Twitter unless they actually are a bond expert. Or go buy, there's a great book, Frank Fabozzi wrote it, The Fixed Income Handbook. Go read that and learn about how bonds actually price and what it means. A 10-year bond, for example, roughly a 20 basis point move in a 10-year bond is about 1 point. For a 5-year bond, a little less. But the point being, 350 over or 300 over for CS Credit Suisse CDS, it's not a calamity, right? I mean, that still means you basically just add that to the 5-year note, right? So you're looking at somewhere around 3.5%, 4% for a 5-year note. You add 300 basis points to that. You're talking about a 6.5% yield. There is a lot of corporates out there who would kill to be able to get 6.5% on some bonds. So it doesn't mean Credit Suisse is out of the woods. Financial companies can certainly go out of business overnight, even if their balance sheet looked healthy to begin with. But this is nowhere near calamity. And I think the point you made, Nick, is probably the most important point. Is back in 2008, when we did have a Lehman moment, there was a significant more debt and leverage on corporation balance sheets, right? Not just banks, right? The banks were 30 and sometimes 40 to 1 levered, but also just regular leisure companies, and entertainment companies, and industrial companies. We went through a huge LBO financing boom in 2007. There was a lot of debt on corporations. So when you start to see a hiccup in refinancings, you had a lot more corporate defaults. What happened with 2008 and beyond, once with Ben Bernanke and now obviously the move to Jerome Powell, a lot of that debt didn't go away. It just shifted from corporate balance sheets to government balance sheets, right? There's an insane amount of debt across the globe sitting at these central banks and at these different governments that used to be on the private side. So what that means is you're probably not going to see the same level of corporate defaults that we saw in 2008, but you could see a real crisis at the national level. And I think the hiccup last week with the Bank of England is, one of a few that we've seen now in the last 9 months here, where you're starting to see some real stress on these governments, on their currencies. And, even today, you had probably what I think is for sure unprecedented. You had even the United Nations coming out urging central banks to stop hiking rates so fast, which is, it just shows you how intertwined everything is now, and how there's really no way out of this, right? There's only three ways out of a debt cycle like we have here at the government level, right? One is just inflate your way out of it, which is what, for the most part is happening. Two is a default. You see defaults here and there at some of the smaller emerging market countries. It's rare that you see it in one of the larger, more developed countries, although it could happen. Or three, it's war, right? I mean, that's where this ends, is war. So, I think there's a reason that Bitcoin has a little bit of a bid to it right now for the first time really in 18 months. Anytime you hear the word government intervention, which is what happened with the Bank of England, some small part of the investing world starts to seek investments outside of this chokehold. And right now, it doesn't take a lot of incremental buying pressure to move the needle in digital assets, given how small this market cap overall has become. And I think you're seeing some of that capital start to fly to Bitcoin. So good for Bitcoin, good, in general for digital assets. Not great for the world. You're certainly not rooting for calamity. But, when you see government intervention, when you see currency start to break, that's a good sign for Bitcoin. So we'll see how this develops. But certainly all eyes are, I think the biggest takeaway is everybody on crypto Twitter, right? They're learning things they never learned before this year. They learned about jobless claims, they learned about CPI, now they're learning about European bank CDS. So I encourage the educational process, but go read a book. Don't just rely on whoever tweets at you. Okay,
we go from being health experts to macro experts, Jeff.
Yeah, that's right. I forgot it. Yeah, everybody was a COVID expert. Well, never a dull day here in digital asset world. All right, moving on. I actually think, Nick, if you haven't read some of the stuff Nick has written, and in fact, I encourage you guys maybe go to our blog, go to ar.ca/blog, search for Nick Hotz, Hotz, and look at some of the stuff he's written before. But he's written a lot of interesting things talking about layer one protocols, how to value them, how to think about them as businesses, as nations. His latest, though, I thought was really interesting, which is a guide to investing in the Blockspace cycle. And it's a lot of, for those who are pretty familiar with the business cycle, he's basically drawing parallels. First I've ever seen of anyone do this, drawing parallels between the business cycle and the Blockspace cycle. So Nick, why don't you tell us first and foremost, what I'm interested in is what made you write this? What made you think about drawing this parallel before you get into kind of the specifics of what the Blockspace cycle really is?
Yeah. So, I was a macro analyst in my past life, and my main focus was understanding the business cycle. That was really the only framework that I kind of ever came across that was really systematic in the way that it helped you understand what was going on in the macroeconomy and allowed you to kind of derive an asset allocation decision, or like a positioning decision from that perspective. And so, what really feeds into that is growth and inflation. Those are the two major drivers of economies. And then those either kind of rotate in a kind of cyclical pattern where growth leads to higher inflation, which leads to policy action, which brings down growth and inflation, and so on, or some type of systemic shock that impacts the supply and demand and pushes you towards one place in the cycle. But between those forces, you can kind of tease out where you are within the cycle and how to kind of position your asset allocation between that. And so, as I was thinking about that, I was trying to think about making some sort of similar framework for investing in the blockchain space. And I was wondering, or I was really curious about what the kind of fundamental force of, driver of the blockchain economy was.
Before you get to that, go back to the business cycle for a second. So you're saying inflation and growth. And you're effectively splitting this into quadrants, right? Where you have 4 quadrants. You have high growth, high inflation. You have high growth, slowing inflation. You have low growth, high inflation, low growth, slowing inflation, right? Mm-hmm. So you're saying effectively at a macro level, independent of idiosyncratic nuances, that at a high level, your asset allocation can be dictated by those things. And right now we are in a low growth, rising inflationary environment, which then would mean what in terms of asset allocation?
Yeah, so it's really about the second derivative, so slowing or accelerating. and it's about relative to expectations. So, I think it's pretty consistently we've been underperforming expectations. So inflation has been slowing faster than expected in regards to like inflation expectations, and then growth has also been slowing faster than expected. So again, these are not perfect representations, but basically that generally means sell equity, sell commodities, interest rates falling, which clearly is the outlier here, and then currencies outperforming equities. So 3 of those 4 have been true. The other one, interest rates falling, has clearly not been true, and that's been driven by the increasingly hawkish monetary policy from global central banks.
Right. Okay. So with that backdrop, sorry, didn't mean to cut you off, but let's go back into then the parallels to the blockchain world.
Yeah, and just jumping off from that, like what is the main driver of the business cycle? It's credit, and when you have changes in credit, that's what impacts greater growth. When credit becomes too much to sustain that level of productivity, you have inflation, and then the central bank and government agencies can control the supply of credit. And the parallel to that in the blockchain world is Blockspace. Now, Blockspace isn't determined by a government or something like that. It's determined by the market, and it's much more like gold or oil in that sense, that when gold prices rise, becomes a bunch of companies who want to go in and mine for gold, and then that increases the supply of gold, bringing the price down, and etc. And you get this kind of cyclical pattern based on that. Maybe there's a big gold deposit that's super easy to mine that you find, and then the supply is increased a lot, and that influences the cycle. But in general, it kind of follows that cyclical pattern. And so, yeah, the parallel here is Blockspace, which is essentially the ability to use data on a blockchain that you can run code or store data on, and it's limited, especially in the sense that high quality Blockspace is limited. So you think back to 2020, 2021. Yes, you can go on Polygon or Solana and execute a transaction for free, essentially. But also there's people who are willing to pay $20, $50 for a transaction on Ethereum because that Blockspace is higher quality. There's more available to do there. There's greater amounts of arbitrage transactions available for higher value, et cetera, et cetera.
Okay. So with that backdrop, if you're drawing that same kind of 4-quadrant, chart or graph with regard to the Blockspace cycle, then, you said before we have inflation and growth basically and the rate of change of those. What are you looking at then here to define this Blockspace cycle?
Yeah, so you can think about it in similar ways. We typically in the crypto community world look at it without really assessing any kind of derivative. So like we look at active addresses or gas fees, for example. But you could say, okay, what's the rate of change of active addresses? That's the direction that is the direction that growth is going, essentially.
That's your demand function. That's your demand.
Exactly.
For
that's the demand. Okay. And then the prices, inflation, is determined by gas fees. At least I'm looking at Ethereum here because it's really the kind of canonical and where we know there's a real market for gas fees for potentially, or we know there is in other places there's kind of a floor for gas fees on other layer one, so it's harder to look at it in a kind of market-based perspective. So where we are now then is we've clearly seen both demand and prices, growth and pricing, inflation slowing since November-ish of 2021, and really we saw growth start to roll over slightly before inflation, and now we're seeing really both. And we haven't seen too much of a sense, maybe slightly on the demand side, the growth side, that any of that is slowing.
Right.
So really, we're firmly in kind of that demand for Blockspace decreasing, the cost of Blockspace decreasing quadrant.
Okay, and if you look back at the last cycle, right? If you're going to call this a Blockspace cycle, well, let's look at the last cycle, right? So I guess the last cycle you would call what, the 2020-21 cycle, or what, the 2017-18 cycle? Like, where would you look at in terms of kind of an idea on whether or not these quadrants actually work and make sense with regard to how prices move?
Yeah, I mean, I would put us, if I was looking, back where the same location was in the last cycle, probably like 2019, late 2018, something like that, where you've had a consistently, year-long period of both growth and inflation slowing. And so then naturally what you would see next would be growth start picking up again.
Right. Okay. Very cool. So what does that mean then? I know you've been, pretty adamant about, kind of how you value protocols, how you look at these as a currency of a nation. And obviously there's a lot of factors that makes a strong nation. What what does this mean then for your thoughts on investing in a protocol itself versus maybe some of the applications built on these protocols as you start to re-enter that growth cycle?
Yeah, so there's a long-term thesis on this that we've written about before at ARCA, and we've discussed pretty intensively, called the Fat Protocol Thesis. That's basically saying that over the long term, tokens of protocols, so a Bitcoin, an Ethereum, tokens of that I would say are currencies, will accrue most of the value in this space. Whereas like in the Web 2 world, applications accrued all of value. Really, the internet itself isn't worth anything, or isn't profit. You can't achieve a profit from that. Regardless of whether or not that's true, I think both sides have pretty good arguments. I would say that the Blockspace cycle is basically making the claim that there are predictable smaller cycles within that broader trend that favor either the protocol layer or the application layer. And I would argue, as we go towards the greater growth that I think is coming next in this cycle, that favors the application layer over protocols.
Yeah, and I think shout out to Joel Monegro and Chris Bernitzky, who I think authored the original Fat Protocol Thesis. And regardless, again, whether it proves true or not, it was a very well written thesis, right? That these layer one protocols would accrue most of the value. I think we've disagreed with that, just because from a cash flow standpoint, we think ultimately a lot of these different applications that are built on the protocols may in fact accrue more cash flows, which then in turn accrues more to the tokens of the applications themselves. But regardless, I think it's interesting the way you lay this out, because there's a lot of competition in the layer one and I guess potentially layer two protocol world, right? So if you do believe that it's going to be basically a business cycle built on the demand for block space, and you have seemingly infinite block space because of all the different competition of the layer one protocols, you could get in a scenario where, yes, a lot of overall value does accrue to the protocols, but not necessarily any one individual protocol, because there's just not going to be that immense demand at any one level. Whereas, you get one or two or three or 10, hot applications that are built across all of these protocols, and you might see that explode, right? I mean, the analogy I like to think about is like, it's rare. Basically, Android and iOS kind of dominate the mobile space, right? How many applications are only built on Android or only built on iOS, right? It's almost none. If they have success in one place, they then build an application for the other one. I think the same thing is probably going to be true here, right? Even though some developers are just, I'm an Ethereum dev or I'm a Solana dev, the reality is if you have a commercial hit, or if you come over from the Web 2 world and port over your users to a layer one blockchain, ultimately you're going to build on every other blockchain. So if you have a lack of, basically block space is just, infinite, and you have, a couple of applications that are not, I could see exactly that, right? That in this next cycle, led by, a few of these applications, just like the last cycle was built by DeFi and NFTs and stablecoins. Who knows what the next, real winner is going to be in the blockchain world, but you're going to see some massive growth opportunities in these applications built on these layer ones and layer twos.
Yeah, and I would push back a little bit on the idea that block space is unlimited currently, at least. That may be the long-term future, but I think the evidence from like 2021, for example, demonstrates that there can be periods where the demand to use block space is greater than the supply of block space available, and that's why you get higher fees on these layer one blockchains. The case I would make is that you've got this structural supply shock coming to block space because of all these great protocols, layer ones, layer twos coming online, and all the upgrades that are happening to the layer ones over the next 12 months or so, that will really kind of move it much more in the direction of what you're saying, that block space becomes very, very commoditized, at least at the level of demand that we need currently to support the existing applications in blockchain. And so I think that really keeps fees low for the foreseeable future. And that's what really pushes the value accrual over to the application side from the layer one token side.
Yeah, well, regardless, it's a fascinating read. I really do encourage those who did spend the 15 minutes with us listening to Nick and I talk. I do encourage you to go take the extra 10 minutes and read the actual piece, because Nick puts a lot of nuance into the write up here and really kind of analyzing this Blockspace cycle. It's a good read, and also, just a reminder too. I mean, I'm an old hat. I worked at Lehman Brothers. I worked at Merrill Lynch. I worked at the companies trading bonds back in the days where the defaults were happening. And then you get someone like Nick and some of the other guys at Arca who are a little younger and have both an academic background, and maybe they have a macro background or a long short equity background or a technology background. It's pretty cool to have a team here at Arca where we have all these different experiences. But definitely for those listening, take a read, reach out to some of the people here at Arca, reach out to our analysts, get a little bit of dialogue going with some of the people who have been in the trenches here and have had different jobs across both Wall Street as well as the digital asset world, because we're really starting to draw some interesting parallels as this industry matures. So that's it for this week. Nick, as always, appreciate you joining. I think listeners can find you where at Nick Hotes, at Nick_Hotes. Is that right?
Nick _ yeah.
At Nick_Hotes. Reach out to him, read the blog, tell us what you think. Appreciate you guys tuning in, and we'll see you again next week. Thanks, everybody.
Thanks, everybody. Thanks, Jeff.